So there's a sense in John's paper and some, but not all of the comments we've heard today that FOMC communications are badly off track. And I'm going to push back on that view a little bit, probably not a surprise. I do understand that the frustration is real, but I'm going to argue that it's somewhat misdirected. And also that while the dot plot has so far not been a particularly good predictor in its relatively short life of actual policy, the SEP and the dot plot are nonetheless useful in revealing the evolution of the committee's thinking over time. That said, I'm sure that we can improve our communications and we'll strive to do so. And I'll provide some thoughts on that at the end. So to begin, I would agree with John that there are three important purposes to the FOMC's communication. The first, to provide transparency that enables Congress and the public to hold us accountable for our decisions on monetary policy. The second, to enhance the effectiveness of policy, as was discussed. And third, to show the full range of FOMC participants' views, even if doing so may sometimes make it difficult for the public to identify a consensus view. And in my view, acknowledgement of this diversity of views is important in sustaining the public's support over time for the Federal Reserve as an institution, what John refers to in his paper as our democratic legitimacy. And I suppose that the importance of this third purpose is perhaps underappreciated in a survey that is directed at academics and professional Fed watchers. In my comments, I'm also going to react somewhat to John's thought-provoking and well-reasoned paper. So, to set the stage a little bit, over the last 20 years, we've seen a dramatic series of changes in the way central banks communicate about monetary policy. And the process began with years and years of research and debate, and a good number of today's speakers and commenters were contributors to that debate. After Ben Bernanke joined the Fed in 2006 as chairman, the Federal Reserve made a series of consequential choices that moved the FOMC in the direction of more and more intense communication. Those innovations were largely in place by early 2012. So I've provided a quick summary of the new policies in my written remarks and in these first two slides. I'm going to skip the details now since they've been well covered and just sum up by saying that there were many fundamental innovations, including the summary of economic projections and later the dot plot, the regular press conferences after meetings at which participants submit their SEPs, and the statement of longer-run goals and monetary policy strategy, which included for the first time a 2% goal for PCE inflation, and many others as well. So these tools have now been in practice for just about 5 full years and in highly challenging times for policy. And so as today's discussion shows, they've come under some criticism. So the event is very well timed. And I want to start the substantive discussion. I think the place to start is just to note that the FOMC is a very large and uniquely structured monetary policy committee. It's one of the very largest, and it is uniquely structured. We've got seats for up to 19 participants, up to 12 of whom hold votes at any given time. Governors are appointed by the president, confirmed by the Senate. Reserve Bank presidents are appointed by those of the Reserve Bank's private sector board members who are not affiliated with commercial banks, subject to the approval of the board. So this unique federated structure was designed to ensure a diversity of views, among other purposes. And my strong view, and here I'll join those who have stood in for the absent Reserve Bank presidents, but my strong view is that this institutionalized diversity in thinking is a strength of our system. My own personal experience is that the best outcomes are reached when opposing viewpoints are clearly and strongly presented before decisions are made. The committee's diversity shows through most clearly at times like these, when economic conditions have been particularly challenging and when there have been significant policy disagreements. Our communications are intended to enable the public to better understand how the committee sees the economic situation and outlook, as well as what the committee is likely to do if incoming data differ from that outlook, the reaction function. My sense is, now, some of you may be thinking of this Far Side cartoon. This sort of brought that to mind. So at the top, he's saying, here, Ginger, and Ginger's hearing, blah, 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 Ginger, blah, 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 Ginger. So yeah, I gave a speech in Indianapolis yesterday at which I talked about the economy, potential growth, productivity, low interest rates, and monetary policy. And I think probably what the press was reporting was blah, 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 December, blah, 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 December. So we can move on from that. My sense is that the markets and other members of the public focus instead mainly on the timing of the next policy change or on how many policy changes there'll be in a given year. It also seems that the public may not fully appreciate the uncertainty that surrounds the outlook. In addition, market participants often say that there are just too many voices saying too many different things, the cacophony problem. The dot plot, as I mentioned, has so far been a poor predictor of the policy path, and some have questioned its usefulness. On the other hand, markets do not appear unusually certain about FOMC decisions. In theory, our communications about monetary policy can be divided roughly into those that express the consensus, as John did, and those that show the diversity of views. And I'm going to focus today on the latter. Specifically, our communications that illustrate the diversity of views about the likely policy path, especially the dot plot and public commentary by FOMC participants other than the chair, currently serving us well? And if not, how can we make improvements? Going back, questions of how much to say about the likely path of policy were extensively debated in the public sphere in the years leading up to the Bernanke era and by FOMC participants while Ben was chairman. The benefits of greater transparency are typically thought to include more efficient pricing of financial assets and a closer alignment between the market's views and those of the committee. Transparency should allow asset prices to respond immediately to incoming economic data, which should foster progress toward the committee's objectives. Those who supported the publication of some form of policy rate path generally saw it as part of a forecast-based approach to policymaking in which policy plans depend in a complex way on policymakers' outlooks, risk assessments, and objectives. After all, the whole forward curve matters, not just the overnight rate. Monetary policy was therefore thought to be made more effective by communication of the full expected path of policy, which could then be incorporated into private sector expectations and longer-term interest rates. Now, all along, there have been other voices urging caution and asking, in effect, how much transparency is too much. As a matter of fact, Don Cohn noted in his 2005 remarks that more is not necessarily always better. We'll call that the Cohn rule when it comes to Fed communication. Critics have often argued that too much discussion of the likely path could be taken as a commitment to a particular path and timing and could ultimately constrain the committee from pursuing what it views to be the optimal path. Indeed, to the extent that the committee's talk about the path of policy is given weight, that talk may leave too little scope for private assessments of economic developments to show through in market prices. Now, John noted in his paper that monetary policy gets pretty high marks from 2008 to 2013. He chose to focus on mid-13 forward. I'm going to raise the ante. I'm going to skip 2013, the year of the taper tantrum, and 2014, the year of the relatively uneventful taper itself, and focus instead on 2015 and 16, which seem to me to be the most relevant years to the challenges the committee faces today. And I'm going to pay particular attention to the dot plot, the cacophony issue, and the need to do a better job of explaining uncertainty. So starting with the dot plot. Dot plot is not a consensus forecast of the committee. Rather, the dots represent each individual participant's assessment of the appropriate policy path. The committee considered at length the use of a consensus forecast in 2012, but abandoned that effort after struggling to reach agreement on its parameters. As you can see from Figure 1, the median dots have moved down from SEP to SEP a lot. The December 2014 SEP median dots showed 350 basis points worth of increases over the years 2015 to 2017. In the event, there was one rate increase in 2015. The September 2016 SEP shows one more in 2016 and two in 2017 for a total of 100 basis points. The next two figures display rate expectations derived from financial market prices and forecasts made by financial market participants, respectively. These market paths have also declined significantly over the period. And the path estimated from overnight index swaps, OIS, on the left has been substantially below the SEP median. So it does not appear that markets have uncritically accepted the dots, let alone taken them as a commitment, at least so far. Some argue that the downward march of the dots has damaged the committee's credibility. For me, the story is both more complicated and more interesting. Like John, I don't think of the dot plot as having been a useful predictor of near-term policy moves. It's really too early to say whether that will be the long-run equilibrium or not, but in its first 5 years, and particularly in the last 2 years, that has not been the case. But that's not to say that the dot plot is without value. Indeed, changes in the SEP and the dot plot over time have been quite revealing about the evolution of policymakers' views about the path of policy. In recent years, FOMC participants have significantly revised their views about the values to which key economic variables will converge over the long term, and the same is true of many other economic forecasters. Since the beginning of 2012, participants' views about the longer-run annual growth potential of the economy have dropped from about 2.5% to about 1.85%. Much of that downward revision in estimates of longer-run potential growth represents implications of demographics and the slowdown in productivity growth. These same structural factors have also weighed on participants' assessment of the long-run neutral federal funds rate, the rate that would be neither expansionary nor contractionary at full employment. The median assessment of the longer-run neutral federal funds rate declined from 4.25% in early 2012 to 2.9% at the September SEP, with 60 basis points of that shift coming just since September of 2015. The persistence of low inflation, despite faster than expected reductions in unemployment, has also led participants to lower their estimates of the long-run unemployment rate, the natural rate. The median estimate has declined from 5.6% to 4.85% in the September SEP. So taken together, these revisions explain a good part of the downward movement of the dots. And one way to see that is through the application of a policy rule, such as the Taylor rule. These policy rules, simple policy rules as they're sometimes called, incorporate key factors for monetary policy, including the natural rate of unemployment, the neutral rate of interest, and deviations of inflation and employment from their long-run values. As we prepare for FOMC meetings, FOMC participants routinely see policy recommendations from a variety of such rules, including several variations on the Taylor rule. While these rules are useful as benchmarks, in my view, they should not be excessively relied upon for actual policy decisions. The red line in Figure 7 here shows the policy prescription using the original 1993 Taylor rule together with the September SEP dots for the federal funds rate for 2016, 17, and 18, year-end. The Taylor rule prescription has been derived using the median value for core PCE inflation, the unemployment rate, and the longer-run normal unemployment rate, the natural rate, from the September 16 SEP. The intercept in this Taylor rule represents the longer-run real interest rate, or R-star, which is set mechanically at 2% in the original Taylor rule. If we replace that intercept with the median of the longer-run R-star implied by the most recent SEP, which, as I just mentioned, is 0.9%, we see that the rule prescribes much lower settings, 110 basis points lower settings, for policy interest rates than does the unadjusted rule, the blue dashed line in this figure. But the lower intercept does not completely close the gap between the Taylor rule prescription and the dots. However, many observers believe that the neutral real interest rate is currently well below its longer-run value. The language that has appeared in the committee's post-meeting statement since December 2015 that, I quote, the federal funds rate is likely to remain for some time below levels that are expected to prevail in the longer run, is consistent with this view. So we can estimate a short-run, time-varying R-star using a standard reduced form IS equation that relates the unemployment gap to its own lagged value and the lagged real interest rate gap. And we'll use the median of FOMC participants' projections from the September SIP in this exercise. The IS specification employed here is similar to that used in Laubach-Williams and is shown in Figure 8. When we use these short-run, time-varying estimates of R-star as intercepts in our Taylor rule, we get the purple dashed line in Figure 9. And the rule now tells us that the median dot remains slightly below the adjusted rule's prescription at the end of 2016 and 2017, but is back in line by the end of 2018. So as Don Cohn recently noted, we have been in uncharted waters with unreliable anchors, well said. This downward march of the dots shows that policymakers have been learning and our understanding of the economy has been evolving as we navigate the treacherous shoals of the post-crisis economy. And that'll be all for the nautical references. The revisions in the longer run values and the short run time varying R-star estimates provide a framework for understanding policymakers' evolving views of the economy and of appropriate monetary policy. And the dots for 2016 to 2017 lie below the purple dashed dotted line in Figure 9, showing that FOMC participants see an even more gradual path of rate increases than is suggested by their short-run R-star estimates. This lower path may be related to global economic weakness and risk management considerations at the effective lower bound. Of course, all of these things, policy would be what it is in the absence of an SEP or a dot plot. So really the new communications tools, what they've done is make this more transparent to the public, for better or for worse. And in this sense, the dot plot is really more messenger than message. I want to turn quickly to the cacophony question. So I think we all hear too many voices offering too much diversity of views on the likely path of policy. Reserve Bank presidents and governors are expected to publicly discuss their views on the economy and policy. Indeed, our own policy says that the committee's public accountability is strengthened by open discussion of committee participants' views about the economic outlook, as well as their judgments about the appropriate course of monetary policy. Central banking often comes across as obscure and complicated, and we try to help the public understand what we do. But there's more to it than that. John Faust's paper captures well the framers' vision of an institutionalized diversity of perspectives. In my view, the public expression of our diverse views helps sustain public support for the Federal Reserve as an institution. Those members of the public who disagree with our policy should know that their concerns are given voice in our deliberations. But there is a trade-off here to be managed. On the one hand, the effectiveness of policy is thought to depend on the public's understanding of the committee's consensus. On the other hand, the expression of diverse views may sometimes make it difficult for the public to see that consensus. John Faust sees this public discussion as mainly a form of negotiation. And there may be some of that, but I guess in my view, the motivations are simpler and more obvious. In addition to our sense that we need to get out and talk in our public role, many of us actually enjoy getting out of the office to speak to outside groups. Just as an empirical observation, it appears that we do enjoy talking to print journalists, and some of us like going on television. With the proliferation of media of all kinds, there is a crying need for content, and we have been willing suppliers. So in my view, these public appearances are not mainly about gaining leverage in negotiation. There is one single FOMC participant who has most of the leverage in our policy discussions, and observers would be well advised to listen carefully to what she says. I strongly agree, though, with John that it's wise not to read too much about the path of policy into all this communication. FOMC participants, other than the chair, speak only for themselves and customarily make that clear at the beginning of their remarks. Their commentary is not intended to express the consensus or to predict its evolution. However, as John notes, during the Greenspan era, there was very little discussion of the likely path of the policy rate, even by the chairman. The proliferation of forward policy guidance during the crisis utterly broke that equilibrium. Many of us now seem to be trained to a new habit, which is to offer one's views about the near-term path of policy, typically at the end of a speech on the outlook. While such communication can serve a useful purpose, I have come around to the view that focusing too much on the precise timing of moves may add to confusion and frustration about our communications. In addition, it can violate the collegial spirit of our deliberations, in which we're not supposed to make up our mind and tell the public that we've done so before meetings. So I am personally trying to avoid this problem in my own remarks. I'll wrap up quickly with uncertainty. All economic forecasts are subject to considerable uncertainty, and there's always a wide range of plausible outcomes for important economic variables, including the federal funds rate. In her remarks at Jackson Hole in August, Chair Yellen showed the median path for the federal funds rate from the June SEP, surrounded by a 70% confidence interval based on the historical accuracy of private and government forecasts. I reproduced that figure here, updated for the September 2016 SEP. Note that the TAN confidence interval in the figure is much wider than the disparity of views as represented by the central tendency of the projections, the black dashed lines. This uncertainty is a fundamental aspect of our world, and it should probably feature more prominently in our communications. So to sum up, the FOMC and individual participants communicate a great deal these days, much more than in the past. Some of those communications are designed to express the consensus, and some are designed to show the diversity of views. In my view, communication should do more to emphasize the uncertainty that surrounds all economic forecasts, should downplay short-term tactical questions such as the timing of the next rate increase, and should focus the public's attention instead on considerations that go into making policy across the range of plausible paths for the economy. Thanks again. Look forward to our conversation.
So what we're going to do is Don Cohn, who's one of our colleagues at Brookings and a former chairman of the communications subcommittee, right. one of more than one we have here, right. Is going to talk with Jay Powell for a few minutes, and then we'll have time for some questions.
Can I get my pen off the way?
Well, thank you, Jay. That was very, very helpful and a great way to end this day, I think, is with somebody on the inside wrestling with these issues. So I was struck by the part of your presentation where you looked at about the revisions to the dot plots, and I was struck by a couple things with regard to that, and they do have to do with communications, I think. One is, I thought you made great use of rules in explaining and using the rules to explain the revision, and helpful with the communication about why things have changed. Yet the Federal Reserve seems adamantly opposed to legislation which would in effect, mandate you're using these rules for communications purposes, both with the Congress and the public. So how do you reconcile what you've done with the position of the Fed?
Okay, so
to start with an easy question.
Yeah, thank you for that. Without wanting to get too deeply into the particular legislation and the enforcement mechanisms and that sort of thing, but to talk more about the use of rules. So I think the first order thing about our communication ought to be our progress toward achieving the dual mandate, our forecast for doing so, and the policy that we see as appropriate for doing so. I would say right behind that, if I could think of one really important thing to communicate to the public about where monetary policy is right now, it would be the changes in these long-run values, changes in the neutral rate, the natural rate of unemployment, potential growth. Those things are fundamentally important to people understanding what's going on. I use the Taylor rule, the 93 Taylor rule, as a lens for focusing on that issue. It's a useful benchmark. As you know well, we do look at a variety of these things in connection with preparing for every meeting. But I guess I see it and wanted to use it in that way. Many Wall Street economists have done that, the sort of similar exercises in the last couple of months. So that is the spirit in which I use it. I say it's highly useful without wanting to get into a debate over a particular piece of legislation.
Yeah, I think I would add to that sometimes these rules and models are much more useful for explaining changes than they are for explaining the path going ahead. And certainly when I was at the Federal Reserve, we used the FRB US model often for explaining deviations from a judgmental path and the effects of variables rather than tracing the rule ahead. So I think I actually agree with the position that use of the rules won't be that useful, or mandating the rules won't be that useful, because I think they're not that useful often for seeing the path ahead, but they were.
If I can amplify it, yeah. I do think they're especially useful in change space. And if you saw the San Francisco Fed piece from last week, they look at the 99 Taylor rule and explain changes between December of 15 and September of 16 through that lens. And I do think it works very well that way as well.
So taking up on that, the San Francisco Fed piece and your speech were very emphasized the role of these long-run variables like this R-star equilibrium interest rate, the revision to growth, et cetera. And yet my sense is that to long-term growth, that Fed communication as we've gone through 2016 and the Federal Reserve has rationalized why there were fewer increases in interest rates, why people might have anticipated a particular date and it didn't happen, has concentrated on short-term events. Brexit was mentioned earlier, weak growth in Q1, the data dependency. So somehow the incoming data and the financial markets have been used to explain. And while there's been some public discussion of the R-star and revisions to R-star, that's not really the way the committee has chosen to explain why they've done what they've done. So I think there's a bit of I think I could use your speech to illustrate a disconnect between what the committee's been saying on a quarterly or 8 times a year basis and the underlying rationale which makes a lot of sense, but isn't really what the committee's been saying.
It's been helpful today and in preparing for this to hear that perspective, because you have to get outside the building and actually hear how people are perceiving what we do. But I would say both of those things have been going on. Just to pick an example, so there was a significant growth slowdown in the latter half of last year, in the first part of this year. We've looked through those in the past because job growth, we've been willing to look through them because job growth has been so strong. But job growth, going into the June meeting, the trailing 3-month job growth number for March, April, May at that point was 118,000 jobs per month, which was a drop of 50% of what the average was for 2015. So that was enough for me to think, let's pause and see where we're going here. Brexit was also happening 8 days later. For me, that was not an essential part of the thing. It might have been enough on its own, but in any case, that's a real thing that was happening in the economy, that financial conditions had tightened dramatically early in the year, with credit spreads blowing out and asset prices off. So I think there was plenty going on in the real economy. We've also, though, stressed, we've had multiple discussions of R-star and these long-run values in the minutes. The chair's given speeches on it. But I hear you, though, that it doesn't seem to be getting through maybe in terms of the framing, and that's something I do think it isn't one or the other, though. It's both.
We've had a couple suggestions here on the statement and how it might be changed. Alan Blinder had a specific suggestion about incorporating really alternative views into the statement that's issued and how the consensus is formed. Vince wanted to rewrite it every time. You could tell he's no longer on the staff since he wouldn't be responsible for providing the drafts. You want to react to Alan Blinder's suggestion or just the general idea? Can the statement be changed to perhaps more accurately and more fully reflect the underlying reasons for the decision and the diversity of views that went into making it? Or is there room for improvement there?
So I liked both the idea behind it and the actual. I liked the pros a lot that Alan proposed. The idea being that you're getting away from the oration of a unitary actor and showing more a compromise. That's really a good thing. And like I said, I really liked it. Ben raised the first question. And these are not meant to be fatally unanswerable questions, but the first question would be, how would you get that done? Having sat more recently than some others in the room around the table as tiny wording changes consume 20 and 30 minutes of discussion. A word, where we go around and around, that sort of thing. So really rewriting the thing. I think what you'd have to do is start the meetings on Monday now and then devote the entire day Wednesday to the actual statement. But that's something that should be able to be gotten to. The other issue would be length, though. So there was a real focus that the statement got incredibly long. when we were doing thresholds and asset purchases and making forward guidance and all those things. It was, it was a telephone book at that point. And there was a real focus on shortening it. But I think, bottom line, I think that it's a promising direction to look in.
So on the cacophony issue, which you raised, what would you do? How would you change things? What kinds of agreements do you need within the Federal Reserve to perhaps emphasize more of the consensus? How would you deal with this problem that a number of people seem to have identified here?
I would be looking to make a change at the margin here. I don't think again, I think there are huge benefits. I actually gave an Outlook speech in Indianapolis yesterday, 700 people in a room, and they hear a speech. They get to know how we think, what we do, what we don't do, what we're not responsible for, and they generally leave with a better understanding. This is a civic audience, and a much better understanding and appreciation for what we do. There's no value in that for Julia. That's not going to help Julia and Peter do their jobs, but I think there's real value in it. So I wouldn't try to do away with that. And I actually think the Reserve Bank presidents do a better job of communicating with the general public than the governors do. We don't have the time, we don't have the bandwidth, we don't have the staff to do what they do and give that kind of a speech a couple hundred times a year. I think there's tremendous benefit in that. So what I would tweak rather, is what I suggested in my remarks, which is just try to dial back the precise focus on the next meeting and what, I didn't actually say what I was going to do at the December meeting, and no one asked. So it didn't, and yesterday in Indianapolis. So that's what the main thing I would do. I mean, our own if you read our policy, it's pretty good. If we all followed it pretty strictly, we'd be in a better place.
And finally, before we break for questions from the audience, I'd like to ask you to reflect on your role as governor. One of the things we've heard today is that maybe the governors don't speak enough, or themselves need to be a little to show where the consensus is moving in Washington. How do you view your role in FOMC communications and the role of the governors, perhaps, and whether that's different in any way from the role of the Reserve Bank presidents?
So we're bound by the same rules, which is if you're going to talk about the consensus, you can give your own views, but give the consensus, and do so not by characterizing it in your own words, but by referring to the specific language in the various consensus documents, the press conference, the chair's remarks, and the statement. So, and it's no different for me than it is in that literal sense that it is for me, for bank presidents. I would say I personally bring to this an idea that when I speak publicly, I'm trying to do things that will support make our enterprise more successful. I'm not looking to make trouble for the committee or make things difficult for the chair. I'm looking for a chance to get my own views out there, but to do a lot of explaining, frankly, of what we do and why we do it, and to talk about relevant economic issues like yesterday, productivity and long-term growth, that the public needs to understand. And I think if you do that and respect the consensus documents, that's the main thing for me.
Right. Thank you. So we have some time for questions from the audience. Do we have any questions out there? Peter.
Jay, you mentioned that folks on the market and elsewhere should listen disproportionately to what the chair says in trying to get a sense for where policy is going. How important would you say other members of the committee, I mean, the two vice chair of the board and of the FOMC, given that there's one chair and only has so much time, could they play, do they play, and could they play a bigger role, and could there be more done, for example, to emphasize the extent to which messages from these three are somewhat interchangeable? It was interesting that the photo op at Jackson Hole this year, where the three were seen together, and sort of so part of my question is, are you willing to give a little bit more quantitative indication of how important the chair is versus others? Are there others that are close and more broadly?
Trying to get me into trouble, Peter. Luring me near the cliff and yelling, "Jump." No, you're right. Traditionally, there has been, that group of the two, the vice chair of the FOMC, who's the president of the New York Fed, and the vice chair of the Fed, and the chair traditionally have formed, a group that speaks with one voice around the consensus, and I do think that's a healthy tradition. Full stop.
Roberto had a question.
Thank you. Governor, so you mentioned the fact that whoever speaks should speak to the consensus that is the official consensus reflected in official documents, right? Which I think is a very much an understandable intent. But on the other hand, if everybody gave out there and gave the same speech, what's the point, right? So do you see some room for differentiation? I mean, personally, I find it useful when I hear different FOMC members expressing different views, because look, I don't have the benefit of sitting in the FOMC room, but this is as close as I get to hearing the arguments that people make in the FOMC, and that helps me understanding, right, how people think and how ultimately conclusions are reached. So do you see some value in people expressing different opinions or not?
I do. I guess I would say it doesn't sound to me like we're at risk of undershowing the diversity of views. It sounds like the risk maybe is on the other side. That's why I say I would only tweak this. I think, look, someone said it earlier, several people did. We can't give the markets and the public more certainty than actually exists. This is a diverse committee. It is actually structured. I was very struck by this part of John's paper. The original framers really made this so that in difficult times there would be disparate views, and it would be hard to reach a consensus. And that's how it is. That's how it's always going to be. We shouldn't make it out to be anything other than that. That said, though, as you go up to a meeting, I think there's a need to respect this what I'll call the collegial process that we shouldn't be saying, in my view, that we've made up our minds, and therefore, why have the meeting? We really should preserve some respect for the collegial process in the lead up to the meeting, where you leave it open that the decision will be made at the meeting and has not already been made by you.
I think another point I would make is this business of reacting. Somebody made this earlier, reacting to individual pieces of data, saying that it pushed you closer or further from the next decision, makes it look like the Federal Reserve is overreacting and not filtering the data through a kind of a medium to longer term perspective. So dialing that back would be, I think, very useful. Mike Prell had a question back there.
Thank you. I've enjoyed the discussion today. I want to make 3 quick observations that I will disguise as questions. The first is about the value of this substantial focus the Fed has been putting recently on R-star, which I think would you not agree that is a very abstract concept one finds useful in certain macroeconomic models, but when the effort is made to quantify this, the confidence intervals are very wide, and that doesn't seem to be part of the customary Fed rhetoric these days. Perhaps John Williams to some extent, but I keep seeing numbers, it's around 0 now, or it's going to go to 2, without an emphasis on that uncertainty. Second question, is the median dot so useful? This was introduced a little while ago, I perceive simply as a token step towards greater transparency. You could have simply released the histogram immediately, and it put more focus on this as a real guide to what the Fed expects to do, if not commitment. So is there a value in being a little less precise? And if you wanted to give a useful dot, it would be the chair's dot, given what you've said about the leverage that the chair has in the decision-making process. And finally, I noticed your comment, which is not the first time I've heard it from a Fed person, that one of the reasons the dots are lower than, for example, your Taylor rule would suggest was risk management considerations. But I wonder whether that really makes sense. I can see why it would make sense, why you would not move perhaps now, but as we're looking out a year or two, either those risks materialize or you don't have a consistency between the dot and your other economic variables. At least I raise the question whether there isn't some illogic in that particular approach. Thank you.
So in my Outlook speech yesterday, I did describe what is meant by the neutral rate. I did it to a civic audience. I think I did it very clearly, and at the end I said it was surrounded by very wide confidence bands. I didn't cite Stock and Watson, but anyway, I think they got the point. I think it's critical to make that point. The median dot, how useful is it? I wouldn't want to put too much on it. I think we ought to consider some of the additional things people want to do. I think a question we need to ask ourselves about them is, do you want to attract more attention to the dots? The more work you do on the dots, the better you make them, the more people will pay attention. And maybe that's not, that's a consideration, let's say. But the median dot, it's of marginal value. Of course, people can calculate the medians anyway. They don't really need us to do that. So I'm not sure I followed your risk management point, though, to be honest.
Well, I think he was saying risk management should fade over time as those risks don't materialize, and so be a less important aspect a year or two from now than they are today.
Well, and that's, as you can see in my Taylor rule exercise, right now the dots are way below the prescription of the 93 Taylor rule as adjusted, but by 18 they've caught up, so you're actually confirming what's in the picture. Don't give him the mic.
If the risk didn't materialize in the near term, the simple logic of a simple model would be you're going to have to do more later on because the underlying economy has performed as you had in your base case scenario.
Right. I don't want to prolong this, but as long as we're within 150 basis points of the zero lower bound, we're doing risk management, no matter what the state of the economy is. It's, you're not away from the zero lower bound the week you lift off. It's always there, to your left, not very far. Until you're at 300 basis points, you're thinking, I need to be careful here, I think.
I would link Mike's point about uncertainty to the median dot. Seems to me the median, by focusing, so I've advocated doing away with the medians, taking that back. And because I think it doesn't really reflect the broad uncertainty, it focuses on a particular path. And yes, the market can calculate the path, but it's different when the Fed publishes it, and it's different when the Fed emphasizes it in its communications. Julia.
So in the context of this discussion, we are in an environment of more elevated uncertainty than usual about the outlook for, say, fiscal policy, how it will affect the economy. In the context of the SEP, how do you approach that? There's not much we know, but we know that there are a wide range of possible outcomes that are very different than what we might have expected. So,
good question, hard question. Very early to say. I just think there's so much uncertainty around what the actual policies will be of the new administration and the new Congress that it's very hard to know. I think the economy is broadly similar. There have been some positive developments in markets. Inflation compensation is up significantly. That's a good thing. But it's really we're not so far from where we were a month ago before the election in terms of where the economy is. So I think it's time to be patient and see how things unfold.
John.
So just on this, uncertainty is just a hard thing to deal with in forecasts, especially when you've got different views about the economy across the 19 people. The SEP is supposed to be a modal forecast. In other words, Mike's uncertainty is resolved in that because you picked the modal path through all that uncertainty. Now the point is, now we can ask who's clever enough in here to know where risk management matters in a modal forecast. Really hard question. I don't think that most folks actually know that. What will the SEP have to be in December? It's sort of like the modal fiscal policy in the views of the individuals, and that'll presumably differ. This just indicates in confusing times how difficult it is to write down any forecast that people interpret properly. And interpreting and just uncertainty in a modal forecast is just one of those many dimensions.
And the one-sided nature of the risk, the asymmetry, just complicates it even further. Yep. Any other questions? Way in the back.
Back on rules for a second, and given the interest on the Hill, I'm just wondering whether there's been any thought given to using documents like the monetary policy report to be a little more transparent about rules you're considering, deviations from them, why it seems there might be a way to sort of mollify some of the concern coming from the political.
So I actually am on the subcommittee on communications. I'm one of the 4 members, and so we do. Just so you know, we still exist. We meet regularly. It's a very the FOMC's calendar is always crammed. There's so many things. It's planned many months ahead. So these things do take a long time. Going to your particular question, though, it's a very interesting idea. I think that's one you've supported.
David Wessel and I actually had a suggestion.
Right. It's on that list. So it's an interesting idea that is probably worth exploring.
So I think we have to bring this to a close. I want to do 2 things. One is I want to thank everybody, all the people from New York who came, braved the weather, Jay in particular for coming, John for the very lucid explanation, and everybody for helping to shed light on something which sometimes seems like it's a sideshow. I mean, after all, the policy is the policy. But I think as we've learned today that the communications is a way to both make policy more effective and to assure the public and the members of Congress that the Federal Reserve takes seriously its obligations for accountability. I want to reiterate something I said earlier, that if we do this again, and I somehow have a feeling that there will be a FOMC subcommittee on communications at least until 2028, Jay, that we'll try and include one of the bank presidents. And I'd like you to join me in thanking everybody for cooperating today.